Hey everyone, Stan here. Let's get started with our daily dose of supply and demand zones that work. And each day, like we've been doing, we'll do another little mini lesson and then tie in trading opportunities from today and yesterday that we had in our sessions to make those points. So remember, we are delivering these sessions to help with any confusion on the original supply-demand strategy. That's what we focus on here. I developed the strategy many years ago on the trading floor of the Chicago Mercantile Exchange. And so we are holding these sessions to help eliminate confusion and bring things back to what's real. Remember, the Pinnacle Institute is not an investment advisor, and make sure you understand that there is no guarantee of success when it comes to trading and investing in the markets. Risking your hard-earned money in the markets, take your time doing that because available research does strongly suggest that active traders lose money. We know that, and most people know that. So take your time, make sure you understand the risk, understand what you're doing, and here we go. Okay. So let's start with a little mini lesson here. How you doing, Raphael? Thanks for the kind words there. Good to see everybody. So today we're going to focus on lagging. Look, there is the conventional school of thought when it comes to fundamental analysis, technical analysis, and then there's real world trading, right? Supply and demand, retail, wholesale, all that. Okay. So now let's hear from you. Tell me some of the most popular trading strategies in the world. What are the, when people are reading books or looking up information on the internet about trading, what strategies, what tools are they using? And I mean the most popular, the stuff that everybody talks about and most people use. What would you say are some of the top trend for sure? That's the big one, right? Most people use trend. You hear the word trend, it's everywhere. Everybody's teaching trend and all that. Yep, moving averages, all the indicators and oscillators, support resistance, things like that. Yep. All of that stuff. Exactly. That is the most popular stuff out there, even today. So how does that work with real world trading, real world buying and selling, real world, making money, making and losing money in markets? Well, let's take a look. Let's start with the big one. And that would be trend. And let's run all these through a simple supply and demand filter, right? So if you think about it, the trend trader does not buy at demand. If you follow trend rules, trend trader doesn't buy at demand. Instead, they let prices turn higher from demand, okay? And then they wait for a series of higher highs and higher lows, and then they buy. The trend trader doesn't sell at supply. They let prices turn lower from supply, and then they wait for a series of lower highs and lower lows, and then they sell. What's the problem? What's the problem with the trend trading? Where are you always buying and selling? In fair value, in the novice space, right? Instead of buying at demand or wholesale prices or selling at supply or retail prices, trend trading has you buying and selling in the middle, and that's a problem, right? You're buying after prices have rallied, you're selling after prices have declined. Okay, that's typically going to be higher risk, lower reward, and certainly lower probability. Yet, it's probably the most popular strategy out there. A lot of people buy when the news is good and sell when the news is bad. Well, if you wait for all the news to be good, and think of how younger people are, we are all taught in school to buy a stock, for example, right? We all had the same lessons in grade school and middle school and high school and university. The lesson is make sure it's a good company with strong management, a healthy balance sheet, right? And good earnings, of course, right? Make sure the earnings are good and all of that. Well, if you wait for all those things to be good, where do you think the price of the stock is? Is it at wholesale prices or retail prices? It's almost always going to be far away from wholesale prices and closer to retail prices. Just like selling when the news is bad, by the time everybody knows the news that's bad, prices are usually already down, right? So buying when the news is good and selling when the news is bad is you're usually taking the opposite action of what you should do, and that's the mistake a lot of people make. Some of you mentioned indicators and oscillators, very, very popular. If we look at moving averages, for example, right, any of them, any indicator, any oscillator, we can look at moving averages as an example. A lot of people use a moving average crossover as an entry into a market, okay? Here we can see, but you can see prices dropped into a demand zone where, according to our rules, we would be a buyer as long as the risk and reward is ideal. We'd be buying. Our rules have us buying right at the demand zone. If we wait for the moving averages to cross, well, that's not happening until price is all the way up here, right? I think we talked about this the other day. If you add any tool to your buying and selling decision-making process that lags price, all you're doing is increasing risk and decreasing reward. Make sense? And of course, last but not least, some of you mentioned some of the conventional technical analysis chart patterns like support and resistance and head and shoulders and triangles and all that stuff. What's wrong with this group, right? What's wrong with this school of thought? Well, if we take one of the most popular ones, the double bottom, which is in almost any trading education center on the internet, right? It's in most of them. You're supposed, if you follow the rules, you're supposed to wait for these two pivot lows, these two bottoms. And once you have them, you're supposed to draw a line right here called the neckline, according to technical analysis. And what are you supposed to do when price crosses above the neckline? You're supposed to buy, right? And if you flip that over, right, and add one more of those, you have a head and shoulders top, right? And in the head and shoulders top, you're supposed to draw, again, a line, across the lows. And when price goes below that line, you're supposed to sell. What's the problem? Why is this group not making all the money? Right? Here, you're buying after such a huge rally in price most of the time, and then you're selling after such a big decline in price. It doesn't make any sense, right? Filtering all this through a simple supply and demand filter, right? We know that, right, when prices reach a level where demand exceeds supply, that's when they're most likely to turn higher. And they're likely to move to a price level where supply is equal to or greater than demand. And when that's the case, prices stop rallying and turn lower. It's simple supply and demand. It's how the markets have always worked. It's how you make money buying and selling anything, right? Wholesale, retail. The problem is when people come to the trading world or the investing world, they throw all that simple time-tested logic out the window and start doing all these other strategies that have the same thing in common. They're all get you in the market very, very, very late, which is high risk, low reward, low probability. So just be careful. Don't do something just because everybody else is doing it, right? Think this stuff through for yourself. Now, after looking at the flaw inherent in all of these strategies, let's look at some trading opportunities that we had today in the markets. And again, these are screenshots from our live trading and analysis sessions. So here was a demand zone that we were looking at, and price came into that demand zone earlier today. But someone tell me, what was the trend in price when prices got to the demand zone, right? Clearly, prices were trending down. Guess what? When prices come down to demand, they're always going to be trending down, right? But according to the conventional rules, you should never buy in a downtrend, right? it doesn't make any sense, right? So we had a qualified demand zone here, sitting well below fair value. When prices get down to demand or wholesale prices, competition to buy causes price to turn and pushes it higher. Also this morning, this was a little day trading opportunity. That last one was a swing trading opportunity. This is Nick. He's another member of the Pinnacle Institute team. He was leading a session in our active trading room here. This is literally just a 1-minute chart of the SPY, identified a qualified demand zone. Okay. And you could see this morning, about an hour after the open, price declined all the way down to our qualified demand zone. But again, notice the trend is down when prices get to the demand zone. It almost always is going to be. Okay. And then, of course, if you used any indicators or oscillators, they're all going to be pointing down when prices get to demand. And take a look at this one. Don't we have a double bottom here? And if you follow the double bottom rules, you're supposed to draw like a neckline right here. And technical analysis would probably have you buying all the way up here. My point is, all of that stuff is almost opposite of how you make money buying and selling anything in life. So just be very careful with all that. Okay. Yes, the reason why a supply and demand zone would fail is because there's not enough of a supply-demand imbalance at that zone to turn price, right? And most zones don't have a big supply-demand imbalance in them, okay? So that's why location is so important. In the middle here, okay? In the middle here, we don't enter positions. When price is in fair value, most rally-based rallies, drop-based drops in fair value are going to fail, right? There's a little supply-demand imbalance there. That's why prices moved away from those areas, but not enough to take a trade, okay? So we want to identify fair value first, and then we look below fair value for our qualified demand zone and above fair value for our qualified supply zone. That's where you have your supply-demand zones with the largest imbalance. Hopefully that was helpful. Good to see everybody. Have a great rest of your day, and we'll do this again tomorrow.